Once the financial statements are prepared, we now want to show you how we use ratio analysis to use the numbers on the financial statements to make conclusions about the business. The first ratio we're going to look at is called the return on assets ratio. The formula for the return on assets ratio is net income divided by average total assets. To calculate the average total assets, we're going to take the beginning total assets number found on a comparative balance sheet, and we're going to add the ending total assets number also found on the balance sheet. We need to sum that together first before we divide it by 2. This number will give us the average total assets for the accounting period. Let's look at some examples for some data for a company called Blue Company. If we go to Blue Company's income statement, we will find their net income number. Then we would go to the balance sheet. If the beginning of the accounting period had $75,000 of assets and the ending of the accounting period had $125,000 of assets, we would add those two numbers together to get $200,000 of assets. Divided by 2 would then give us $100,000 of average total assets. We're now going to take our net income of $15,000 and divide it by the $100,000 of average total assets. Our calculator would show 0.15. We could also turn this into a percentage by moving the decimal place 2 to the right, and then we would get 15%. All right. Also, another way that we could use the 0.15, if we were just looking at the 0.15 then, is we could say, reminding us of what the formula is then for the return on assets ratio, the formula up above shows net income divided by average total assets. If we use that by taking our 0.15 answer for Blue Company and put it divided by 1 down here, we could also say that for every $1 of an average total assets Blue Company has, they earn 15 cents of net income. But what do we do with our 0.15 or our 15%? We need to compare it to something to see how we feel about Blue Company's results. So let's say that Green Company is Blue Company's competitor. We would also want to calculate the return on assets for Green Company. Again, the net income for Green Company is $10,000 found on the income statement. Going to the balance sheet then to calculate the average total assets, what if we found that Green Company had $90,000 of beginning assets at the beginning of the year, and they had $110,000 of assets at the end of the year? We add that together and divide it by 2, we also found that Green Company had also $100,000 of average total assets. So when we calculated their $10,000 of net income divided by their $100,000 of average total assets, they come out with 0.10 or 10%. So now we show that Green Company has 10% return on assets, whereas Blue Company has a 15% return on assets. Now looking at our two results, we need to know, is the return on assets ratio that is higher, Blue Company's 15%, or lower, Green Company's 10%? Which result is the preferred or better result? And the return on assets ratio, the higher result, is the preferred result. Therefore, we would say that Blue Company's 15% return on assets is the preferred or better result. But we don't just want to say that Blue Company is better than Green Company, because that doesn't describe what Blue Company is better at. Therefore, the next thing we need to know about this return on assets ratio is what is it a measure of? The return on assets ratio is a profitability measurement. Therefore, we would not say that Blue Company is better than Green Company. We would say that Blue Company is more profitable than Green Company. Now I'd finally like to look at a comparison of Blue, Green, and Purple Company because it demonstrates a common problem that some students have. If we were looking at all three of these companies, some students might just look at the net income number and they might inaccurately come in here and say that, oh look, Purple Company has $80,000 of net income. Therefore, they are obviously the more profitable company because net income is sometimes referred to as profit. But this inaccuracy shows that the students are just looking at the dollar amount instead of the ratio relationship. So, in this case, I had made both Blue and Green Company both have average total assets of $100,000. So when looking at their net income number, we would say, oh yes, I would like to earn $15,000 rather than $10,000 on my average total assets. Therefore, Blue Company was more profitable. But now if we look at Purple Company, true ratio analysis takes the size of the company out of play. Therefore, we don't just look at Purple Company's $80,000 of net income. We now need to go to their balance sheet, calculate their average total assets, and what if on the balance sheet we found that the beginning of the year had $800,000 of average total assets, plus the end of the year they had $1,200,000 of total assets. Add that together and divide it by 2, we have $1 million of average total assets. Therefore, Purple Company, when you take their $80,000 of net income and divide it by their $1 million of average total assets, they only have an 8% return on assets, or they are only able to generate 8 cents of net income for every dollar of an asset that they have. Therefore, when we look at true ratio analysis, we would find that Purple Company is the biggest company. That's why they had the most dollar amounts of net income. However, when we did ratio analysis, according to the return on assets ratio, they are actually the least profitable of all three companies. So once again, ratios take the size of the company out of play.